Hello there, AT&T employees. Welcome. Thank you so much for joining us today. I'm Sam. I moderate these presentations. I will be behind the scenes today. If you have any questions, there is a Q&A box on the screen. Feel free to ask away. It's completely anonymous. I'll be monitoring those questions and I will be fielding them to one of our AT&T advisors to address with you after the presentation has ended, either through phone or email. I apologize in advance. We don't have time to answer them live with you. Today we have Patrick Ray on. He is one of our AT&T focused financial advisors, and he's going to be speaking to you about whether to take the lump sum or the annuity when you decide to leave AT&T. It is a huge decision. There are many, many factors that go into which would be the best option for you. So he will cover all of that with you today. Before he comes on, very quickly want to remind you, we are not AT&T here. We're not affiliated nor endorsed by AT&T, so please keep that in mind as you're listening along. We are a group of financial advisors. Speaking of being financial advisors, we would love for you to book a free 15 or 30-minute consultation with one of our advisors here. We have many that are very, very well versed in all of the AT&T retirement plans, and they would love to speak with you at no obligation to you, of course. There will be a link. I'll enter it into the chat. It'll pop up right above Patrick's head. Click directly on that. It'll guide you to our website where you will find our calendar, and you can book a time that is convenient for you to speak to one of our advisors. You can also follow us on YouTube, and you can connect with us on LinkedIn if you have a LinkedIn account. We would love to connect with you there. We post a lot of content for AT&T, both active employees who are transitioning into retirement as well as retirees. So we post a lot of content that we think you would find very useful, and we would appreciate your follow and your connection on LinkedIn. So please consider that. And without further ado, we're going to jump right into it now with Patrick Ray.
Hello, everyone, and thank you for joining me today. My name is Patrick Ray. I'm one of the senior advisors here with the Retirement Group and Wealth Enhancement. And in a moment, I'm going to cover an agenda to give you an idea on what we'll chat about today. We're going to talk specifics about pension disbursements and some different options that you want to consider when transitioning into retirement. And then we're going to talk a little bit about the planning purpose of what's involved and why you would want to consider a plan itself, on top of why you may want to work with someone from our firm. So, as it turns out, retirement income will have different sources, and depending on where you are in your life stage and retirement stage will dictate how some of these play out to you. Social Security is going to be one of them. Job earnings, because some of you potentially could leave the payroll and still work at another location or another type of environment to create some additional income, maybe to offset some healthcare expenses, among other things, as well as your savings and investments, and then your pension benefits, which we'll talk a little bit about today. So on the agenda from the pension side, we're going to talk about the single life annuity, the joint and survivor annuity. We're going to discuss what a look back period is, and we're going to talk a little bit about interest rates and how they are specifically correlated to your pension, and then the lump sum option. And we'll talk about why you may want to consider that versus the annuity payment. But as far as the annuity payment is concerned, in general, the context of the pension is scheduled and built around having a monthly annuity payment at age 65, okay? So the benefit is calculated as a monthly single life annuity. And if you weren't eligible as an employee, your legacy plan's merger date, which would dictate the formula of how the legacy ends up playing out and what plan, in fact, will be your highest pension value. If you are an eligible employee after your legacy plan's merger date, then the benefits are based on a multitude of factors, but in general, as a single life annuity under the age 65 monthly annuity benefit. So under the single life side, you have a monthly single life annuity, which is the form of all payments of which are derived, and it pays you a fixed amount per month for the remainder of your retirement lifetime. It's important to note that there is no cost of living adjustment on your single life annuity. So if you get paid $2,000 a month starting on day one, you'll have $2,000 a month payable to you for the rest of your life. Now, if you're married, you're going to have your spouse sign off on a form that's required if you take the single life annuity. But many of you who decide to take the annuity payment will end up with some sort of joint and survivor option, assuming that you are married. And so what happens is upon your death, a percentage of the monthly benefit that you collect while you're alive gets paid to your joint annuitant during his or her lifetime. And the cool thing about how the AT&T pension plan is structured, and it does not apply to many other plans around the country, which is if you take a reduction of your benefit, there's a pop-up provision that protects you in case somehow your spouse, whom you're protecting in the event that you die before they do, if your spouse dies before you do, then you can get a one-time pop-up provision, which allows you to take a death certificate, send it back into Fidelity, and then you'll get a bump up to the single life annuity format of your plan and your payment for the rest of your life. And so, of course, that allows you to be somewhat protected in the untimely event that your spouse dies before you do. And it's unique because it's not a normal course of a pension layout for many companies across the country. And so certainly this is an added value to you as an AT&T member. Now, the lump sum option is certainly a favorable option in many formats or many cases, and it allows you to create some additional liquidity over and above what you've saved in your investments and your 401ks and so forth. And the lump sum payment is an actuarial equivalent of the total annuity payments that you would have otherwise received during your lifetime. And so they calculate this using actuarial forms or factors which are based on your life expectancy, the interest rate environment, and then your annuity start date. And so the key is this is a one-time payment to you in lump sum format, in which then the liability then relies on you to generate income for the rest of your life, and then AT&T owes you nothing in the event that you suffer an untimely death. So there are no death benefits payable under this plan option. Now, in case you're wondering how this works, many of you might have heard, or maybe you know, that the interest rate has an inverse relationship to your lump sum. So when interest rates go up, your lump sum goes down. And conversely, when lump sums or when interest rates go down, your lump sum goes up. And so another way to look at that is this exercise that we put together that allows you to compare your annuity payment that you otherwise would get to your mortgage payment. So hypothetically, let's assume that you're getting a $1,950 monthly annuity payment, which in turn happens to also equate to what you're paying on your mortgage. The difference between these two are under the Bank A option related to your annuity payment. Your annuity payment would be derived under the 4% format, payable for 30 years, which in turn gives you a sum payout over your lifetime of those 30 years of $408,500. In comparison, if you went to another bank to refinance your mortgage, and instead of having a 4% loan, you'd have the same payment, but it would only be a 3% note. What happens is over that 30-year window of time, you end up paying and having a total of $462,500. So in this particular case, you can see that a 1% decrease in interest rates provides over a 10% increase in your lump sum. So again, if you're trying to time the best ideal date to leave the payroll, it would be when the lowest interest rates environment would apply to your option. And so another unique thing about the format of how the pension works is a look back period. And in a perfect world, you'd love to have the option to look backwards to see exactly what transpired so you know exactly what to do moving forward. And in fact, the way the pension and interest rates are designed at the company is it allows you an entire tax year to effectively look over how the rates are trending in an effort to make an informed decision on when your best date to leave the payroll would be. So observation of historical interest rates give you some feedback and some data points to look back and see where the rates are basically trending. And remember, if the rates are trending upward, that would reduce your exposure to how much money you're going to end up getting in the lump sum, which may in turn mean that you would want to commence your benefits sooner rather than later. And so inflation trends during this window of time give you or influence your lump sum values, which means this look back window or this look back period we're discussing is an incredibly valuable tool for you as a retiree. And it provides you some stability in your pension calculations so that you can make the correct assumptions. And certainly when and if you're running a plan, which you should be, to determine how much money you're going to end up with so that you can in turn project out what your retirement looks like. Knowing the interest rates are an important factor in this grand scheme of projections for sure. And so let's take a look at what this means to you. So you can see that each year the rates are set for the following year. So in case you didn't know, the rates are effective in November, and they're good for the following tax year, all the way from January 1st to December 31st. So what that means is that the rates that we're using in 2025 were established in November of 2024. And regardless if you retire in January of 2025 or the end of the year, you can allow yourself to commence your benefit, which you would then want to use this look back window to see what rates are doing. And as we see today, we can see that the first segment has been reduced by about 40 basis points. The second segment is about the same. It's trended slightly upward. And then the third segment is about a half a basis point up, or 50 basis points upward from where it was in November of 2024. And so as a refresher, the first segment deals with the first 5 years of your retirement. Segment 2 deals with years 6 through 20. And segment 3 deals with years 21 plus. So depending on how old you are would dictate which one of these segment rates would impact you more. And so another significant factor of assuming or trying to calculate what your lump sum will end up being and assuming a certain rate of a return on your investments would dictate a lot by how much you get from your pension. So knowing this interest rate is a crucial factor in the part of the planning process that certainly we would talk to you about and help you understand in the grand scheme of how it applies to you and your family. So this is a way to look at the trends of how they have been transpiring over the most recent 10 years. And so you can see that all the segments they work somewhat similarly. So when segment 1 goes up, so does segment 2 and segment 3. And conversely, when segment 1 goes down, so does segment 2 and segment 3. But they go down or they react in different formats or different time frames. So the reality is, knowing these rates and how they apply to you, again, is one of your biggest credentials that you can have in your back pocket for learning and understanding what it is to do with respect to how you take your plan option from the company. And so remember, we know that most people don't plan for retirement. In fact, statistically, 74% of people over the age of 50 do not have a written financial plan. And to be honest with you, there's no reason for that, because firms like ours do this as a complimentary service to you in an effort to explain to you how they can be a valuable partner in retirement. And so if you're looking for a partner and someone to help you transition into a successful retirement and take care of you for years to come, then you would want to use this as a tool to interview the potential retirement firm that you're thinking about doing business with, so you can see if your goals align with what their experience is and what they have to bring to the table. And so as far as the retirement group is concerned, many of you know that our experience comes in great detail and length in dealing with folks who have worked with or worked for AT&T. And we have offices all across the country. So we have a ton of experience in dealing with your savings plan and your pension calculations and your medical plans in an effort to provide you the most accurate understanding of how those things would specifically apply to you and your family. And as I mentioned, the complementary cash flow analysis is simply a tool for us to gather some data from you. So if you're willing to spend some time with us, we're willing to give this to you at no obligation or cost to you. And we would learn about your situation and what your goals and objectives and things like this are to put together a plan to show you if you're on pace and if you're on target to meet your overall goals, or if you're as close as you think you are, or if you're farther away than you actually think you are. Certainly all of those things would be incredibly valuable data to understand going forward, certainly from a planning perspective. So if you're open to discussing your situation further, you would email us at info@theretirementgroup.com. That's one way to get a hold of us. You can also call this 800 number, which is 800-900-5867. You can take a picture of this QR code to the left, and it will bring you straight to a calendar where you can pick a time to talk to either myself or one of my colleagues who can help answer a lot of questions that you may have regarding some of or any of these topics that we've discussed today. As well as, if you haven't already started, you should follow us on our LinkedIn page. And this is the QR code to the right to give you access to that, which is a company-specific page where we have a lot of data related to just your plan and all of the things that we know that are incredibly helpful as an AT&T employee, certainly on the way or transitioning into a retirement. And so with that, I will leave you for the afternoon. Thank you very much for spending some time with me. I hope you found some value in what we had to talk about, and we'll look forward to discussing these things further with you when you're up for it. Have a great day. Take care.